You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, let's do it. Let's dance. Time for episode 2 of our doubleheader of Options Bootcamp, the premier options educational program. My name, of course, Mark Longo from don't forget the optionsinsider.com. The place to go. Great shows, obviously, up there. Great content as well. A lot of earnings data you may want to see. Check out Earnings Volatility Fund. This is the season for it, listeners. We give you all that data, and we don't charge you a penny for it, unlike some of these big research houses or other places that try to put it all together in these expensive reports. We give you arguably the best data going out there, the most actionable, certainly, and it's all free because we love you. TheOptionsInsider.com. Click on the Options News and Articles tab to begin your journey to the dark side of that data. And then, of course, if you do like what you see on the website, on the shows, throw a review our way. It does help new folks continue to discover the content. Just like this week's 5-star review comes from BX Green. He says, amazing how long these guys have been talking about options. So much info here, I feel like I have to listen twice. Well, you know, that's the nice thing about the podcast format, BX Green. You can do it at your leisure, on your own schedule. The person next to you at the desk, if you're working or whatever the case may be, doesn't have to know you don't know this stuff. If you're supposed to be a financially savvy person, you'd be surprised how many quote-unquote pros are listening to our basic educational content, listeners. A ton of them, so you are not alone. And then also, if you missed something, don't understand something, you can just listen to it again. It's really easy. So that's why we like this format. That's why we embraced it so many years ago, 16 plus years ago. That's why we still stay with it now. Because video, you kind of still have to be available to watch. You can't be driving or doing something else. Audio, we can always get at you no matter what you're doing, where you are. And folks can listen over and over again on demand, which we love out there. So thank you, BX Green, and everyone else takes the time to rate and review out there. If you want to join all of our pro folks in the live, we're getting episode 2 in their ear holes right now. You don't want to wait a week for all these double headers, and we're going to do a lot of them. These come on all the time here, listeners. Our travel schedules here are crazy. Then head on over to theoptionsinsider.com/pro. That's the place to go to get both episodes in your ear holes instantaneously, to get a lot of other early content coming your way before it hits the network, to get a bunch of exclusive shows, including Options Oddities and Pro Q&A sessions. Just had a great one with the folks from IB. Last week had Jim Carroll, the VIXologist, on there yesterday answering your questions. So a lot of great stuff there, as well as, of course, great giveaways, pro trading crates out there, all kinds of fun. TheOptionsinsider.com/pro. Dare I say it, one of the best communities out there in the option space. People are just nice. They're cool. They're all there for the same thing. No jerks. It's a great place. TheOptionsinsider.com/pro. Speaking of jerks, let me welcome on my co-host now, my partner in crime, the black-headed one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program. Take no offense, sir. I'm just speaking from the heart.
Well, hello there, Mark. How are you?
I robbed you of your enthusiasm for the rest of the show, sir.
We'll see.
All right, I'll see if I can wake you up then. I'll make amends as we keep on rolling. A little bit of the old options drills.
Howlin' Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills. Let's see if we can collectively wake Dan out of his lethargy. Get him going again. Get him fired up. I know what'll get you fired up, Mr. P. It's one of your favorite topics. It's strike selection. You think you can get back into that again this week, sir, after such a deep dive last week, a.k.a. a few minutes ago?
I believe I can.
All right, we'll see if we can get you fired up. Last week, listeners, of course, we touched on single leg strike selection, whether you should go out of the money, at the money, in the money, how it varies depending on long premium versus short premium. But now let's get to where the rubber really meets the road on a strike selection basis. These are spreads. And of course, there are many different flavors of spreads, many different ways you can carve up the onion in this space. And the strike selection is going to dictate a lot of how you set those up. For a lot of the spreads we talk about here on the show, could be straight verticals, could be butterflies, whatever the case may be. For a lot of them, the short strike is where you want that spread to gravitate towards. So that's going to be a lot of your crux, a lot of your focal point when you're setting these types of spreads up is where is the short leg? What's going on out there? Can I get to that in a reasonable amount of time? Can we expire around that level? These are all things that will dictate how you set these up. But Dan, you've been talking a lot about strike selection over there at MTM. Let's take it now to the 201 level. Let's talk about spreads, sir. What do you have to say about strike selection when you're setting up your spreads?
Yeah, so strike selection when it comes to spreads is one of the most important things you can consider when you're setting them up. The last show we talked about doing them like an outright long calls or puts. But, you know, I mean, you can be wrong if you choose the wildly wrong strike when you're buying calls or puts. But when it comes to spreads, it's very easy to be wrong. And, you know, if you don't construct spreads right, you can have a great forecast. You can, you know, have a very logical trade. You know, you can really understand all the inner workings, the fundamentals, the technicals, but you set that spread up using the wrong strike price and you can lose money super easy. So it's extremely important to, you know, especially, well, credit spreads, wing spreads, debit spreads, and even time spreads. You know, usually those are at the money, of course, if we're doing them sort of traditional income generation. But I've become a pretty big fan of directional time spreads lately, too. And choosing the right strike for those is something also.
Let's start basic and work our way up, sir. Start with our basic traditional vertical, keeping everything in the same expiration cycle, just looking up and down the options chain. Let's go long premium, then we'll go short credit spread type. How do you approach those from a strike selection basis?
Yeah, so one of the big, most understood things. Oh, Mark is sending me these ridiculous comments about how he's helping me. So one of the most misunderstood things that people who are new to even experienced option traders is that debit spreads and credit spreads are basically the same thing. In fact, synthetically, they are exactly the same thing when we use the same strike prices. Now, many people who are newer to option trading and have developed some level of comfort with one or both of these, but aren't so in tune with what synthetics are and how they work, will give a little pushback, whether that's in your own mind or like actually verbally saying, no, Dan, you're wrong. But the thing is the only difference is the stock price relative to the strike prices. Typically, credit spreads use all out of the money options, and that's not necessarily true for debit spreads. It can be true, but basically an in the money call debit spread is synthetically equal to an out of the money put credit spread. So why do I say that? Because I'm going to actually reverse the order of what Mark was suggesting, because it makes more sense to do it that way. If we are looking at a stock chart and we think a stock will not get above a certain level, and now just think intuitively, why would we think that? Well, probably because there's some sort of level of resistance. There's, from a technical standpoint, there would be something holding it down, right? That ends up potentially making a good call credit spread candidate. We're going to look at a couple of other factors like the time to expiration and the volatility level and such. But if there's resistance, we've got, that's a map of human behavior. That's a map of where the sell orders have been in the past. And so what we, once we do our other analyses besides just, the line in the sand point, what we want to do is set our short strike at or above resistance when we're using call credit spreads. Why? Because that improves our chances of winning. If we use something like delta, that doesn't improve our chance of winning at all. That's just a sliding scale trade-off between probability of success and your risk-reward ratio. Like, there's not any one delta that gives you an advantage over another delta. So that's what we do with credit spreads, and it works the same for put spreads, except we use support. When it comes to debit spreads, the synthetic equal to credit spreads, there what we always want to see is we want the stock to get above the short strike if we're talking about call debit spreads. Why? Because then we can think of it as its synthetic equivalent, the put credit spread. And so we're basically using the short strike, as a target, a point that we think the stock can get above, but not necessarily much above. We would choose a completely different strategy if we were looking for a really big move. Now, there's two different strikes when it comes to a vertical spread. Working from the debit spread side of it, we discussed what the short strike, how to select the short strike. That's basically your target. But your long strike is what controls your delta. If we want to go further in the money, we get a bigger delta and it's more directionally sensitive. And we might end up in a situation where we're not paying time decay at all if we buy one in the money and sell one out of the money. Might be Vega neutral as well, which can be very beneficial. It's a little bit ironic, but it ends up being a more directional trade than buying a call if we construct our debit spreads using the correct strike prices. With credit spreads, as far as the long strike goes, we already discussed how to set up the short strike. That determines that helps determine our risk reward ratio, and how much we can make on that trade. I typically like to go consecutive strikes. You almost always get a better risk reward ratio when you go with consecutive strikes. But you can skip strikes, and we see using Credit Spread Genius, for example, that a lot of professional traders will skip strikes and skip like a lot of strikes, sell it closer to the money and buy it really, really far out. Now, that changes your risk reward ratio pretty greatly and gives you a lot more risk, but it gives you more reward too. So there's a little bit of a brain dump. I want to give people a little bit of time to digest some of that.
Let's go on, because you mentioned, of course, skipping strikes. That leads directly to fly. Speaking of skipping, we'll probably skip straddles for the purposes of this conversation, and even iron condors, because for the most part, those are going to line up and orient around the at-the-money strike. So there's not a heck of a lot of strike selection nuance that goes on there. You could argue with the iron condors and even the iron flies. Where you put the wings could be a bit of a question. That's obviously going to depend on a lot of different factors there. But for the most part, the meat, the guts of those is going to be on the at-the-money strike. And that's what you're really focusing on. So for that perspective, we're going to hold off of straddles, iron flies, and iron condors on this. But you mentioned skipping strikes, which leads me directly to butterflies. Another strategy that I know a lot of our listeners like. Some like it from the long side. You think of it more as a kind of premium harvesting tool. However you look at it, Dan, what are some of your rules of thumb when picking your strikes on a fly, sir?
Well, as far as strikes go, if I keep it very short term and I am looking at it as a premium harvesting thing, I mean, that ends up being pretty straightforward. I keep it at the money. Now, that being said, I can make sort of a more general statement that kind of makes things a little bit more clear and simpler, I think. Basically, what we're always trying to do with any sort of balanced butterfly, whether it's a straight butterfly or an iron butterfly, as long as we're selling the middle strike, is we're looking to set that middle strike at the point where we believe the stock will be at expiration. Now, a couple of caveats there. First of all, we're probably not going to hold this all. In fact, we're absolutely not going to hold this all the way until expiration, because one of those short options is going to be in the money, which is probably not your objective when you put on a condor or an iron condor. So we're going to take it off before expiration, but still, the way to think about it is this is where I think the stock will be at expiration. The next thing is that it's never going to be there anyway. But it's kind of like, playing darts or any game of accuracy. If you focus on trying to hit this exact spot really far away, the more you focus on that exact spot, probably the closer you get to it, right? You're not going to hit it every time unless you develop a massive amount of skill. But when we construct our butterflies or iron butterflies in such a way where, this is where I think the stock will be at expiration, even if we don't hold it all the way at expiration, even if, it's almost never going to be actually at that strike. If it just gets close to expiration, the more skill we develop in getting closer to that target, both time-wise and strike-wise, the more successful we're going to be when it comes to setting up butterflies.
It's always successful, Dan. It's our listeners' questions. Let's get to some of those now. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's get to it, listeners. A little bit of the old mail call. We talked about in our last episode, our question of the week about digital options trading, in particular, how you get in your crypto options exposure in your securities account. Some surprises lurking out there. Speaking of surprises, Dan, we were doing our Advisors Options show earlier this week with a former guest on this program, Mr. Matt Amberson from Orats. And he was out there very vocally calling for the S&P to hit 3,000 before it hits 5,000, even with where we are right now. And just statistically, obviously one is much closer than the other. So we thought we'd put that out to our audience. They are the ultimate arbiters, Dan, to say, hey, do you agree with Mr. Matt Amberson's call for the S&P to hit 3,000 next before it hits 5,000? Dan, do you think our audience agreed or disagreed?
Well, I would hope after watching this show, they would disagree, because mathematically, the bet that has edge is 5,000.
Yeah. Yeah, statistically, one is leaning a little bit closer than the other. Yes, our audience, savvy bunch that they are, Dan, 76.2% dismissed Matt out of hand. They said, no way. Only 23.8% bought what he was selling out there. So he was a little disheartened about that. But we'll see. Maybe we'll bring him on this show again down the road and we could cheer him up. What do you say, Dan?
Yeah, I mean, Matt's one of the smartest guys in this business. So, but he was probably trying to be a little emphatic and, probably makes.
He usually speaks from the data side, though. So some of his models are leaning that way, which is interesting in and of itself. Doesn't have to get to 3,000 listeners. It can certainly sell off. I was joking with him. I said, what if we get to 49.99 and then we turn around towards 3,000? You're going to look like a genius of all geniuses out there. Speaking of geniuses, listeners, we have a question from Shane Hughes. He says it's a newbie question. And you know what? There are no newbie questions. We're all learning here, Shane, and everybody else. So send in your questions, no matter how dumb you might think they are. Like Shane asked, this may be a dumb question. Nope, they're all good questions, Shane. He says, but I'm going to ask it anyway. Well, good for you. I like trading credit spreads, but it has always seemed like the risk to reward ratio was off. It doesn't make a lot of sense to me to risk $4 to make $1 from theta decay. Would it make sense to use the credit received from the spread to buy an out-of-the-money call or puts to open up the potential profit side of the trade in the event a stock makes a big move? For example, if I sold an at-the-money or slightly in-the-money put on SPY and bought an out-of-the-money put and sold an out-of-the-money call, if that makes sense, bought an out-of-the-money put and an out-of-the-money call, bought it against it. If that makes sense, why don't more traders do that? If it doesn't make sense, why not? Am I missing something about the Greeks that makes this a bad play? Not a dumb question, not a bad play, Shane, just a different play. That's what you're talking about here. When you're talking about credit spreads, the key is in the name, right? Credit. That's what you're doing it for. You're there to collect that credit. Now, in your example, you're talking about selling an out-of-the-money put spread and then using that credit to finance buying an out-of-the-money call. That's a different thing than just a straight out-of-the-money put credit spread. Now you're talking about effectively a bullish risk reversal. That's what you've legged into now. You have taken the proceeds from that put credit spread and used them to finance an upside call purchase. So in that scenario now, you really diminished, if not spent, all of your credit from that put spread to buy that call. So your traditional premium harvesting type approach where you're going to make your money doesn't apply here. If you hang out here and stock doesn't really move in this scenario, you're not really making a lot of money here because you don't have a lot of credit left, if any, to sit in your account. You're really banking on now this stock turning around aggressively and blowing through that upside call strike, and that's where you're going to make your money on that strategy. So if you're going to do that from the outset, I would caution you against that. If you like the levels you've identified with the stock and you're comfortable selling a put spread on it, that's fine. That's a perfectly acceptable approach. If you decide now you also want to use that put to finance a call, that can be fine as well. But just make sure you do that analysis on the outset. Don't just waste your credit buying out-of-the-money options on the off chance that your spread goes against you, because now you've turned your trade into something else and you've gotten rid of all the reason that you got into the dance to begin with, the credit. You spent it all now. So now you need something else to happen for this trade to make money. And otherwise, if it does keep selling off, you could actually end up losing money and you don't have that credit cushion anymore. You spent it. So, yeah, it's not a stupid question. It's just a different trade. It's a bullish risk reversal. And so in that scenario, you want a cheap swing at the upside bat in case this stock aggressively turns around. It's not the same thing as just selling a put credit spread and looking to harvest that premium. Dan, what do you have to say here for Shane, who wants to know why more people aren't using the proceeds from their credit put spreads to finance out-of-the-money call purchases?
I think that there's a flaw. There's a logic flaw just going into how Shane's thinking about this. So let me ask you this, Shane. Would you buy a U.S., 10-year Treasury bond that pays 25%? Because if you did, what's the worst that could happen? Well, the U.S. could go bankrupt and completely default on the bond, and you lose whatever you paid for it, which is pretty unlikely to happen. But if that doesn't happen, you're going to make 25%, right? So that's risking 4 to make 1. And this is literally exactly risking 4 to make 1. So I think the way you have to think about credit spreads is not just, hey, I'm risking 4 to make 1. It's I'm risking 4 to make 1, but what is my likelihood of success here? We kind of talked about that when we were talking about setting strike prices in this show and the last one. If you believe that your chances are, better than 1 out of 5, or, you would definitely put on that trade. If you think they're worse than 1 in 5, then you wouldn't put on that trade. So, it's really, really important to consider that, at least conceptually, right? I don't go and try and measure, hey, I think I have this percentage of a chance of making money on this trade. But, sort of in the back of my mind, I have some sort of confidence level. I weigh how far away from the strike it is. I weigh if there's support or resistance. And at least sort of semi-consciously do, weigh, at least from a qualitative standpoint, what my likelihood of success is, and is this risk-reward ratio, in this case 4 to 1, is it worth it?
Yeah, I like a good bullish risk reversal, probably more than the next guy. But you have to be careful when you're doing those. That has to be your strategy from the outset. You can't just decide to, hey, I'm going to harvest these puts, and then, oh, by the way, maybe I'll buy some calls too. That has to be the analysis. You have to say, this stock's turning around, and I think this strike is a good call to buy because it can get through there by expiration. And then I also don't mind acquiring myself some of the stock if it drops to this level, so I will sell a put against it and then use that to finance the call, so my net outlay is dramatically reduced as a result. And then, of course, in your scenario, you're also buying the out-of-the-money puts to protect against the stock really falling out of bed. But that has to be your analysis at the outset. It's not just, hey, I'm going to harvest some puts, and then, oh, by the way, maybe I'll put this money to work doing something else. It tends not to work out that way. So not a bad question, Shane, just a kind of a different beast. Just as long as you're viewing it through that lens. You can be good, but don't just sit there with a credit burning a hole in your pocket saying, I got to spend it on something. That way lies ruin there. Unfortunately, that way also leads to the end of our show for this week, listeners. But before we go, Mr. Dan, if folks want to reach out to you, they want to talk about put credit spreads versus bullish risk reversals or strike selection or any other fun nuggets we talked about here on this show, 3,000 before 5,000, where should they go? What should they do, sir?
Yeah, always glad to help. Make your way on over to markettaker.com, 2 T's in a row, and you can, just go to contact us, or better yet, for the time being, you can actually join our chat room for free and get answers from me or from our other coaches or from the community in general. People are posting trades there. Really, really useful stuff. Not to mention you get some complimentary options classes when you join our community for free as well.
There you go. Check them out, markettaker.com. Don't forget the second T for theta. How are you going to harvest all that juicy theta if you leave off the second T, listeners? Markettaker.com. That is going to do it for us here today on the network. Back again tomorrow with our usual slate of Thursday shows. The option block in the morning with our friends over there from SIBO. Then after that, This Week in Futures Options with our friends over there from CME. So 2 different sides of the coin out there. Should be a fun one. Friday, of course, volatility views. And then after that, for all you pro folks, exclusively for you folks, options, oddities. Of course, if you're not listening to the full network, what the heck are you doing? You're missing out on all those shows. And then if you want to go above and beyond, get the fun pro stuff in there as well. TheOptionsInsider.com/pro is the place to go to learn more. As we get on out of here, back again next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.